So let's practice with a given example here. How would you come up with just a very simple, basic income statement? Now, you don't have to be accounting majors. Some of you are not even business majors, but I think that all of you need to at least understand how the income statement works. And so I'm going to demonstrate it here. Revenue is on the top line, net income's on the bottom. So first, in order to calculate revenue, you need to know how many units you sell. So assume here, as I give here, that we have 3,000 in June, 4,000 in July, and 5,000 in August of these shaved ice at $3 each. So if we have 3,000 units, 4,000, 5,000 on the top line, that's just given there as a help. That wouldn't usually go on the income statement. But then revenue would. That's the top line. So 3,000 times 3 is 9,000. 4,000 times 3 is 12,000. 5,000 times 3 is 15,000. So that's how much money you're bringing in. And then how much money are you spending? Here I give an assumption that you spend $100 on ice and syrup for 100 snow cones. So that's $1 per snow cone. So if you have 3,000 units, that means that you're spending 3,000 on ice and syrup. If you have 4,000 units, you spend 4,000. 5,000 units, you spend 5,000. So that's an expense that you're going to take out of that revenue. And then you're going to pay wages. In this case, I assume that there's 2 employees, $10 an hour, working 8 hours a day, 25 days per month. $20 an hour times 8 hours is $160 per day, and then 25 days per month. So that's $4,000 per month. Very simple. There's other taxes that you would need to pay, withholding and so forth, but this is just a very simplified look at how do you come up with an income statement. And then assume that you have some other expenses. I just threw in here some Facebook ads cost $200 a month. That's another expense. So you take your revenue minus all of your expenses, and that gives you your net income. And in this case, you can run this business as an LLC and not have to pay taxes, so you can just ignore taxes in this case. So there's much more complicated income statement material that you could go through, but you should at least know this. You will need to know this for the quiz. So this is kind of the level of detail that you want to put in the actual text. In the appendices, you're going to put the detailed financials with a lot more detail. Of course, you know that there's other costs involved. If you're going to process credit cards, you have to pay part of the purchase price to the credit card issuer, and the bank gets some of that money. So you don't all of the money, you have to give up part of it. We've talked about break even in kind of the daily or weekly or monthly sense, that how many units do you need to sell every day to be able to cover your fixed expenses. You could also think of that as break even, to say how many units will I need to sell eventually in order to break even from my initial investment. And that makes a lot of sense if you're putting a lot of money into the business to start it. So that's something that you might want to consider. So if it takes a lot of money to start, you should think about break even in comparison to the initial investment. You'll also include cash flow statements. Now, why do you do this? If you have taken accounting, maybe you were frustrated with cash flow, but it's very important for startups because you can actually go broke while still being profitable. And the way that happens is that you can have revenue that you don't actually receive in cash. You can also have expenses like depreciation, which reduce profit but are not a cash outlay. So please remember that cash flow does not equal profit. Profitable ventures go bankrupt all the time. If you don't receive the money when you ship the product and you have to wait for 90 days, you might run out of cash. If you're building up inventory and that takes cash, you might run out of cash as you're growing because you have to buy more and more inventory to be able to, the products that you're going to be shipping, but you don't receive the money yet. So these are important things. So profit equals sales minus expenses, but some of your expenses are related to cash and some are not. So let's think about this real closely. I want you to understand this. So if you purchase a facility, does that show up as an expense on your income statement? Well, actually, in accounting terms, it doesn't. It shows up on your balance sheet as a new asset, but it doesn't show up. You can't expense it, a facility, on your income statement. Same with buying large new equipment. So that costs money, but it doesn't affect your profitability. You need to remember that as a concern. So if you're buying facilities, buying new equipment, that's going to take cash, but it won't look like it on your profit and loss statement, because those two items don't show up there. Same with a loan. If you get a loan, you're going to have cash in the bank, so you're going to have a new asset on your balance sheet, and you'll also have a new liability, but that doesn't show up on the income statement. Same with an equity investment. Again, you receive new cash, and then you have a new equity investment on the balance sheet, but that doesn't show up on the profit and loss or the income statement. I'm not going to require you in the quizzes to do some cash flow analysis, cash flow statement, but you do need to remember that this is the general idea of calculating cash flow. You have to think about where money is actually being spent in cash, because that's the most important part when you're a business. It's easy to run out of cash when you're a startup. So it's very important to remember it's easy to run out of cash as a startup. A few other cash flow issues. So you can run into problems if you give real lenient terms saying, oh, you can pay me when you have time. Or if you sell on credit and then they don't pay at all, then you can run out of cash. Even though you look like you're profitable as a business, you can run out of cash because you're giving too lenient of sales terms. You can also have problems with seasonality. If you have to buy a bunch of inventory and you can't sell it until a certain time, you can spend all your money on inventory and then have too many costs to keep going. Same with capital purchase. Again, you won't have to do a cash flow statement for the quiz, but I provide this as a reference for you to remind yourself of this if you're doing the financials. And then, of course, there's other expenses that are involved in having employees. You have to pay Social Security and withholding. Maybe you're providing some other benefits, and so you have to remember that employees there's a lot of other costs that come in addition to their hourly wage. So you might want to think about, when you're hiring, to be very careful, as shown here in this slide, that you want to be very careful in hiring, because when you hire, you might need to fire, and that becomes really complicated. So what can you try to do? You can try to do things yourself, outsource, contract, so 1099 some people to start rather than hiring employees. Same with facilities. Rather than buying, you try to stretch your money, share with somebody else, use a home office. With new products, try to share components between products. Do everything that you can to conserve cash so that you don't run out. You can also outsource some of your activities so that you can move more quickly. Accounting, IT is easily outsourced. Now we'll move on quickly to the balance sheet. The balance sheet has to balance, so the assets have to balance the liabilities and equity. And so what we're doing here is this is a pro forma balance sheet, so this is going into the future. This is a picture at one moment of time. I give an example here, but it's in the spreadsheet as well. So you have to remember about all of the assets, how you record them. Current assets are those within a year. Fixed assets are those that can't be converted to cash within a year. Liabilities are what you owe. Owner's equity is the net worth of the business, the excess of the assets over all liabilities. Okay, so in conclusion, as I said before, assumptions are the most important part. You need to show that you've thought through things. And as you thought through this, you need to show that it's both credible, believable, and attractive. So sometimes businesses don't look that attractive to an investor. They may work, but they're not really profitable. They don't really provide much of a return. Now, if you inflate the numbers too much, then you're no longer credible. So just a rule of thumb is you should be able to say these things with a straight face and actually believe these numbers. And as many of my guest speakers have mentioned, it's important to have some startup money so that you can actually make this work.